welcome to Business Incorporated live on Channels Television, your daily window into the world of markets, money and global economy. Here's what we're tracking today. Now, South Africa's private sector shows weak growth in August. And Tanzania lowers fuel prices again. And Egypt's non-oil private sector shrinks again in August. Now, great to have you for this half-hour show. I'm Will Ibang. First, as always, let's check in on the commodities market. And we're checking on the oil space once more. Oil fell for more than 1% on Wednesday ahead of an OPEC Plus meeting this weekend where producers may discuss another output hike for October. According to some sources, the group could unwind part of its 1.65 million barrels per day cuts on top of the 2.2 million barrels per day increase already agreed for April to September, and the 300,000 barrels per day boost for the UAE. Let's look at what we have on the screen for the oil market. We see that projected there, oil prices at the Brent crude at $67.84 a barrel. And we see WTI at $64.25 a barrel. Now let's look at the oil space now and see, the metal space, and see if that fared any better. Gold prices climbed to a new record on Wednesday, holding above $3,500 as expectations grew for a Federal Reserve rate cut this month. Spot gold rose to $3,537. We'll see that on the screen there. 0.29 set $3,537.29 per ounce, up 0.1%. U.S. gold up 0.4% to $3,604.90 per ounce. Spot silver, however, dipped. We see it's also a similar dip for palladium and platinum. That market's focus now is on Friday's U.S. jobs data for clues on the size of the Fed's move. So this is why we're seeing this negative sentiments to that. Now let's move on to all the news stories that are trending in Africa. We see Tanzania Energy and Water Regulatory Authority, EWURA, has reduced pump prices from September the 3rd, with super petrol down 98 Kenyan shillings to Tanzanian shillings to 2,807 Tanzanian shillings. And we see diesel at 2,754 Tanzanian shillings and kerosene at 2,774 Tanzanian shillings per liter. Now, EWURA says that the cut follows lower free on board prices in the Gulf, with diesel prices dropping 5.5%, kerosene 3.5%, and petrol 0.2%. A stronger shilling also eased cost pressures. Now, the move contrasts with Kenya, where motorists continue to pay higher prices for petrol, diesel, and kerosene during the same period. Now let's check in on Egypt. The non-oil private sector, we see that shrinking again in August, with the S&P Global PMI slipping to 49.2 from 49.5 in July. That's marking the 6th straight month below the 50 neutral threshold. Now, firms cite weak demand, inflation pressures, and economic uncertainty as drivers of falling output and new orders, though the contraction was milder than historical trends. Now, input costs rose at their lowest pace in over 4 years, easing margins as selling prices increased. Employment also edged up for a second month, but purchasing activity and inventories declined. Let's check in on South Africa's private sectors. Also, we've seen that logging only a marginal expansion in August, with the PMI easing to 50.1 and from 50.3 in July, according to S&P Global. And now output rose for the first time in 3 months, driven by better domestic demand and new projects, though international sales fell for a 5th straight month amid tough conditions with U.S. clients facing higher tariffs. Activity was supported by softer input costs and a stronger rand, while supply chains improved. However, manufacturing jobs continued to decline, highlighting ongoing pressure in the labor market. Now, still in South Africa, delegates at a serious social investing conference taking place at the Gordon Institute of Business Science in Johannesburg say collaboration is vital to driving impactful social investment and restoring dignity in vulnerable communities. But with youth unemployment still among Africa's biggest challenges, the focus now shifts to practical investments in skills that can truly unlock young people's potential in the economy. Our South Africa reporter, Innocent Somota, has more.
Now in its 7th year, the 2025 Serious Social Investment Conference has brought together more than 200 business leaders, policymakers, development practitioners, and social investors. The conference is hosted by Chikululu Social Investment under the leadership of its CEO, Liane Emery Hunter.
What is exciting for me is that it is really convening so many players in the industry, both social impact practitioners as well as donors. And I can really already feel the energy for collaboration, systemic change, and really this wanting to create a better future for South Africans.
Delegates are confronted with the urgent question: can social investors help rebuild a nation in crisis, especially given the high unemployment, service delivery, and inequality challenges in the continent?
The kind of social issues we face within the African continent requires greater coalition and partnerships to be able to systemically address unemployment, economic disparities, and the likes.
Some highlighted the challenges the continent faces in advancing meaningful social investment.
I think a lack of access is probably one of the strongest impediments to youth unemployment that we find in South Africa, and I think continentally as well. As an organization that has been in South Africa for over 67 years, we've built a formidable network and ecosystem of collaboration with people in the automotive value chain. And I think when you combine that access and giving access to young people as well as that network as well, we're able to see results and impact of our contribution.
With South Africa's high unemployment rates, delegates here believe that a serious social investment and collaboration between public sector and private sector can go a long way in getting South Africa out of this crisis. But they say that that will take a serious commitment from leaders. From Johannesburg, South Africa, Innocent Samosa, Channels Television.
Now let's get a check-in on our African markets. We see negative sentiments for most indexes, most exchanges at intraday. Nigeria's NGX still sustaining negative sentiments at intraday. From yesterday's close, now we're seeing 0.2% down at intraday, 138,505 points, dropping further down from that 140,000 level. And DSA in South Africa, we see it on the opposite direction, trading up 0.36%. Let's look at Egypt, if they fared any better. Egypt was down more than 1%, I can tell you that, 1.18% at 34,741 points. And we see Kenya for the second consecutive day, closing Tuesday's trading session up in the green, now at 175.21. But more is still going on because several factors contribute to the market, and forex market is not out of it. Nigeria's Naira has held steady in recent weeks, with traders pointing to the China-Nigeria currency swap as a key factor. The deal allows businesses to settle trade directly in yuan instead of dollars, reducing pressure on the Naira. Now, meanwhile, Nigeria's trade with China, we see that hit approximately 25 points. $2 billion, that's in 2024. But with imports, we're seeing that imports from Nigeria at 22.7 billion, exports is just 2.5 billion. The deficit that we're seeing now stands at $20.2 billion. Now, to help us unpack this development, how do we bridge this gap? What next to do? Bankole Odusanya, Chief Dealer, Polaris Bank Treasury, joins us virtually. Good afternoon, Bankole. It's good to have you on the show.
Good afternoon.
Bankole, we've seen this development going on here with the renewed currency swap agreement between Nigeria and China. How much impact do you see it having on bridging the trading balance we have here and also easing dollar demand in the near term?
Yeah, it's going to help improve liquidity in the system, in that demand for USD, the demand will be there. We have a liquid market, but a lot of the demand that used to chase on Asian goods right now will be sorted on the yuan to Naira exchange. It's been in existence for as far back as 2017, but we've seen an expansion of the agreement. And of course, the rates are, I don't have the rates at hand, but we know that in due time we'll get the rates and see the modalities of the agreement that we have. But we have information that Chinese importers, that is, who want to export raw materials away from Nigeria for production, are already considering and holding a lot of Naira, and this would help strengthen the currency. As we speak, we have seen the Naira and the interbank move from about 1,540 to about 1,525 as we speak. There's a likelihood that tomorrow we will close at 1,520 going into the holidays as against next week. But this is the beginning of the end of this quarter. We have another quarter that will highlight most probably a strength to the Naira in the last quarter of 2025.
Okay, so you just talked about that. Can you tell us in detail, maybe to what extent has this deal, the swap, like China, taking Naira now in exchange for, instead of dollars, how does this really help stabilize the Naira? You mentioned that, but is there any real tangible impact that we're seeing that we can hold on to?
Okay, so in 2017, 2018, when we actually kicked off, the volume of exchange weren't much, even though we saw some of our customers move away from demanding dollar outright to getting their trade deals done via the Naira Yuan exchange. This is to be expanded and to be, of course, extended. So that's what we're seeing, and it simply means that there will be reduced pressure on the Naira chasing the dollar. That's just it. It simply means that we are not intermediating with the dollar, simply buying and paying using the yuan. And we're seeing a reverse impact also, the reverse transaction where Chinese factories and companies that seek non-oil exports from Nigeria are also beginning to buy the Naira directly via the same platform that was started from way back 2017, 2018. So basically, it helps to extend an advantage that was there and then to expand further what was agreed on the initial. So basically, it takes off some pressure from the Naira, and then we're even beginning to see some reverse gains. Yeah, and then going into next year, we expect that trade would improve between Nigeria and China. We hear that the Chinese government are considering that from Africa, there will be no tariffs on exports of raw materials to Asia, to China. And this is, one of the largest consumer of African resources. And we think that this is going to help a lot. So that's why some of the Chinese factories are beginning to hold the Naira, because you need to sell some dollars in your holdings to get some Naira to pay for Naira products. Say, most of our arable products, such as seeds, the various seeds that were taken out, the shea butter that has become so much talked about of late. So basically, we think that that window is going to expand and help a lot going into next year.
Definitely. China is in the news, all for the right reasons, we can say, with the marking the Second World War today. It's big events that are there. But looking at this shift from dollar and to yuan taking Naira, how sustainable do you think this is? Because you know that many Nigerian businesses still prefer the US dollar because, it's globally accepted. But what would it take for the yuan, let's say even the Naira, to gain stronger trust in trade?
The impact will be felt more on the non-oil sector, because for the oil, of course, the petrodollar will do more of crude oil and refined products being traded using the dollars. So therefore, we see more of that being retained in the Naira dollar spectrum. But going into the non-oil sector, especially export of crops and other resources away from Nigeria, a lot of that will be paid through yuan, and then for services will be exchanging via the same platform, Naira Yuan agreement, for those who want to import equipment and finished goods from China. So basically, that's the way it's going to work. We're going to see more impact on the non-oil sector, where demand will shift away from the US dollars and then use of the Naira Yuan window, where, all banks are on that window. We can provide, once you provide your trade documents on what you want to pay for in China, we can make the Chinese yuan available to you.
Oh, that's fantastic.
This is new. I'm emphasizing that it's not new. It's just an extension of an agreement that had kicked off way back 2017, but this is expanded, and now we're beginning to see Chinese firms wanting to buy Naira because they will be needing Naira Nigerian products exports very soon, given that we'll be paying no tariff to export goods to China.
Well, that's something we'll be looking forward to, sustained interest in the Naira. Now, beyond bilateral swaps, what longer-term reforms could truly ease dollar pressure and, build more resilient foreign exchange system in Nigeria, in your opinion?
In our opinion, we are beginning to see Naira strengthen against the USD because a lot of money is coming in, majorly from FPIs and from a lot of peer-to-peer exchanges that are happening. A lot of firms that do take in money, repatriate funds from diaspora Nigerians. We're seeing a lot of inflows and liquidity, improved liquidity. Every day we're seeing the Naira gain at least nothing less than between 2 to 5 Naira. I mean, we started this August with at about 1,540 and we're close to 1,520 now. So, and we see this continuing. Like there's pressure to sell for those who are holding dollars. They want to sell quickly and get the best value to do their transactions in Nigeria. So basically, we expect this to continue, this stability to continue, and marginal strength of the Naira. We'll probably end the year, I mean, going to possibly 1,500 to the US dollars. But going into next year, 2026, that will be a pre-election year. Towards the end of 2026, that may be a pressure point where a bit of the FPIs who are coming for OMO bills may not roll over all their maturities, so we may see some pressure. But for now, going into last year, in the next 12 months, we foresee stability and the liquid market.
Definitely, stability means there's no uncertainty in the market and businesses can do their business in peace. And definitely, looking forward to a dirty December. Thank you so much, Bankole Odusanya, Chief Dealer, Polaris Bank, for sharing your insights on Business Incorporated. So let's look now to other markets in the Gulf. We see stocks traded mostly negative at intraday. Dubai is down 0.57%. Abu Dhabi trading in opposite direction, up 0.33%. Let's look at what Saudi and Qatari indexes performed. Well, in the red at intraday, 0.19% down, and Qatari index was down 0.28%. Let's look at the U.S. markets now. They went from flat. We see futures going from flat to higher early on Wednesday after the federal court's decision in an Alphabet antitrust case fueled optimism that the tech giants will be able to weather regulatory threats. Now, Dow Jones Industrial Average futures, we see that dropping 0.02%, and we see S&P rising on that news, trading higher by 0.4%, and the Nasdaq futures was up 0.66%. Now, shares of Google parents jumped 6% in pre-market trading after that federal judge ruled Tuesday that Google can keep its Chrome browser but won't be allowed to strike exclusive search deals and must share its search data with other rivals. Now, decision avoided the worst-case outcome for the tech giants. Now, let's get the highlights of Tuesday's trading with our correspondent, Maria Bird.
The U.S. stock market sank on Tuesday as the Dow Jones was down at 0.6%. The S&P 500 was down at 0.7%, having its worst day in over a month. And the heavy tech Nasdaq was down at 0.8%, as companies like NVIDIA saw challenging days, declining by more than 2%. It is also clear that investors are watching and expecting the jobs report. This will be an indicator whether or not we could see interest rate cuts in the near future. But September is historically a very slow month and one of the worst months of the year. So there are not high expectations for the month of September, but there are many hopes that we could see interest rate cuts and a strengthening of the U.S. economy.
Thank you, Maria. Now, investors are eyeing the August jobs report due Friday as next month's major test for stocks. Now, let's look at Asia markets very quickly and see how they traded. We see Nikkei down 0.88%, and this is as investors assess the rising global bond yields and the latest developments on the trade front. Now, we see Kospi in South Korea bucking that trend, up 0.38%, and we see Hang Seng down in China, 0.6%. Let's look at Shanghai, the mainland China. We see that down over 1%, and we see the Nifty 50 in India trading up 0.55%. But let's look at now markets in Europe and see how they're performing. Did they do any better? We see news coming out of there, and we know Lars has some great news for us. Well, if it's great news, if markets are performing any better. Lars, what's happening in Europe?
Yeah, hi Will, how you doing? I know we've seen markets here trade sideways for a while now, and we've heard traders worry for a while about the DAX possibly breaking out of its range to the bottom rather than top if it does ever break out. And indeed, this seems to be happening right now, after a pretty sizable drop. Yesterday, we've seen it in the US too. We've seen it around the world, but we've certainly had it here. A drop that was based on inflation yesterday. The DAX is actually currently up a bit, but it's not winning back very much of what it lost. So despite lower prices, there are no investors coming back into the market, or not a lot of them at the same time. On the bond market, yields are up. So there's real fear now that stocks might be weak for a while, and that maybe we're inching closer to a correction like some people in Frankfurt have actually been warning about.
We will definitely keep tracking the market, but there's been some talk about defense, this week, and we've seen that impact in markets. But with the EU deciding on how to prop up their military, Lars, what's the latest on this story?
Yes, well, to make it short, Russia's aggression against Ukraine, of course, made it clear to everyone in Europe that war can happen, and very close to home as well. Ukraine is a democracy that had moved closer to the West and was looking at NATO membership. It got attacked, and Russia, of course, as the aggressor, shares a border with Finland as well as the Baltic states of Estonia and Latvia, all members of the European Union. So there is a heightened sense of alert among all European nations, and that at a time, of course, when the West is also weakened, specifically by US President Trump's lack of support for NATO and his apparent indifference to what exactly is even happening here on the continent. So that's where we're at, and it's why the 27 EU member states have just decided to increase their defense spending by 11% to a record 381 billion euros. A third of that, that's around 130 billion, will go right into military equipment, into buying fighter jets and tanks and submarines, weapon systems and such. Growing position in the military budget is also research and development. And then, of course, spending on personnel is also growing vastly as the EU member states are trying to recruit and train more people than they actually had in past years.
So, Lars, seeing all this investment, the amount you mentioned now, does the EU feel is sufficiently defended?
Well, that's a little bit of a problem right now, Will, because while spending is up and obviously the understanding of the need for a strong military has changed, there are areas where a lot still needs to happen, and personnel is really the biggest problem right now. Because, like I said, they're trying to recruit more people, but they are not really successful at this point. EU-wide, the number of soldiers has just gone up by around 1% over last year, and that is not enough. Not only when we look at the general need for the EU to better defend itself against potential aggressors, but also because when we're seeing this spending that I just mentioned, spending billions on new equipment, those tanks and jets, they need to be flown and driven. They need personnel, of course, for upkeep and for repairs. After all, the best equipment, of course, is of not much use if you don't have enough people using and taking care of it. So the EU is obviously willing to up its investment, but they're not quite where they need to be.
Thank you, Lars Alter from Deutsche Welle for that update.
Thank you, Will.
Now let's check in on the crypto market now. We see Trump's family on the crypto project. World Liberty Financial has begun burning its namesake token in a bid to boost its price, which has been in decline since launching to the public on Monday. Now, on-chain data first reported by Look On Chain showed the platform burned $47 million. That's right there on the screen. And we see the tokens on Wednesday, permanently removing them from that supply. Now, the token began trading on secondary markets for the first time on Monday, with its early investors allowed to sell their holdings to the public. The token briefly hit a peak of, 0.33 cents, but it's continued to decline, dropping 3.8% in the past day to just over 23 cents. And let's go what's happening next. We see crypto exchange OKX was fined $2.6 million by the Dutch National Bank for offering cryptocurrency services in the Netherlands without registering with the regulator. The fine covers the period from July 2023 to August 2024, before new EU regulations came into effect. OKX stated the issue was resolved with affected users migrated to their licensed European entity. Now, the company emphasized its focus on compliance and secure operations going forward. Let's see what's next. Crypto.com CEO bets on Fed rate cut, and that is Chris Mazlek is confident that digital assets will be boosted in the fourth quarter of the year, primarily driven by the U.S. Central Bank reducing interest rates. Now, Mazalek said in an interview with Bloomberg on Tuesday that Crypto.com's revenue is likely to be better this year, especially if we see a Fed rate cut and a strong fourth quarter following. He added that he is betting on the U.S. Federal Reserve cutting rates at the September 17 meeting, which is usually good for crypto as borrowing becomes cheaper and more liquidity is available for riskier investments. And that's it on Business Incorporated. Thanks for watching. I'm Will Ibong, and I'll see you tomorrow.